rolled over out the front of my house and I just had the smell wafting in. I didn't know what to do. So I just ran out there and grabbed one and then came back in. So I apologize about that. But no, seriously, I'm just late. So I apologize. Maybe that's my joke for this week. But thanks for joining us at Selfwealth Live. My name's Owen Rask, the founder of the Rask Group. It's my pleasure to have you with us as we recap a bit of reporting season. And actually, the reason that I was late is that I was just digging into some of the results that have come out. And for those of you that don't know, we talked about a few weeks ago how before February, so February is reporting season and so is August, but before February, we have something called confession season. Confession season is when the companies that are expecting bad results have to come out and tell you because they have a legal obligation to inform all shareholders. But then the other thing that happens is right towards the very end of reporting season, it tends to be the case, not always, but it tends to be the case that always the companies with the worst results come out. They leave it to the last minute. It's kind of like when you're in school or university and you have to hand in an assignment and you wait to the very last minute. Like, surely the professors know that as the time goes on, the assignments towards the end, on average, are worse. Maybe not. As always, I'm joined by by Rob behind the mic, and it's my pleasure to have you all here tonight. So we've got Danica, Paul, Jason, MLS, Caroline. Who else we got here? Mike, Fleur. Everyone's in attendance. It's fantastic. So I'm hoping we can get a bit of Raptor. It's back. First live session in a while. It would appear that I just realized I think I've got my rabbit in the room with me. I don't know where it is, but it's somewhere in here. So if you hear some thumping, that's what that is. JJ, don't worry, mate. If you were late, I am too. Jonesy, good to have you with us. So I'll get to some of the formalities in a minute, but last week I posed a few questions to you. So I'll drop them in the chat now. Last week I posed a few questions and they came from Morgan Housel, who wrote this tremendous blog a little while ago that basically says, Chef Circle, Eve, wonderful, wonderful. Good to see you. Morgan Housel, who wrote these questions, and I just put the link in the chat, that kind of like were a pause for reflection. And one of them was, what do I desperately want to be true so much that I think it's not true, that I think it's true when it's clearly not? He poses these wonderful questions. You might remember the question that we had last week. What are we ignoring today that will seem shockingly obvious in a year? I mean, there's quite a few. Mark, good evening. I mean, there are so many things, like so many things that I desperately want to be true, and I sometimes believe them. But then there's, I have to really ask myself, what are the pieces of disconfirming evidence when I've got confirmation bias? Alex, wonderful to have you here. And I just love these questions that Morgan puts out, and I just spend a bit of time reflecting on them. Like, what is it? What do I desperately want to be true? Probably long-term investing, but that I think is true. Although maybe like short-term trading, some people believe that they can trade stocks and grow wealthy. Maybe that's something that people desperately want to be true when it's clearly not. I find a lot of people in my industry tend to market an investment product or an investment service when they don't believe in it, but then they end up believing it because they market it so much. So Chef Circle, I just got one. Katie, hello. So just a quick dad joke. Why did the chicken click the PowerPoint presentation to get to the other slide? That's my joke for this week. I think that's a 10 out of 10. My everlasting source of wonderful jokes is dad jokes, or Dad Says Jokes, here on Twitter. You can go and follow them if you like. Just a quick disclaimer before we get into the actual investing stuff. The reason that we're all here tonight, my name's Owen Rask. Anything that is presented tonight in this video, this live stream, if you are attending live, most people watch on replay, but if you are watching live, is limited to general financial information only, or general financial advice, they call it under law. That just basically means that any of the advice or information that's given tonight is strictly general in nature. It doesn't take into account your needs, goals, or objectives. So you should speak with a licensed financial planner before you act on any of the information. As I said, I'm the founder of the Rask Group, and we're authorized to provide advice under a license. The AFSL number is 383169. Whew, okay, now that I've got through the disclaimers, that was fun. 6 out of 10 says, well, I'll take a 6 out of 10. On the inverse scale, it's a 10 out of 10, says Jason. Well, inverse, not so bad. I'll take any scale that's a 10 out of 10, to be honest. Selfwealth/Rob gives me a 9 out of 10. Interesting, mate. Interesting. So now that we've been through confession season, then we went through traditional reporting season, and we got to the end of the month of February, and we had, we'll call it dirty laundry season. We can now see that there have been quite a few different results. I'm actually going to put my, if I can, I'm going to see if I can do this. I cannot do that. Okay, that's not good. We'll try this one. So as we can see, at the end of the year, the end of the month, there were probably quite a few takeaways for me, and I'm sure you'll have some too. Good evening, Jaden. Please let me know what your takeaways were from reporting season, because obviously I don't get to see all the results, so I don't know exactly what happened. But for me, some of the key takeaways were this. Number one, that investors and the companies like management teams are expecting more pain ahead. And I put CBA in brackets here, and CBA didn't necessarily say this, but they just said that they're well provisioned for bad loans. And so what we've seen with some companies that provided good results, they've provided good results in the year or half year ended 31 December 2022. But as they look forward, they've said, they haven't given the best guidance. So for example, in CBA's case, they are expecting that, provisions for bad loans might increase. Number two is that mediocre companies are growing weaker, faster than I expected. So what I mean by that is some of the companies that reported results have actually got a lot worse. Even though I thought they were bad companies to begin with, they've got worse faster than I thought they would. And there are some examples which we'll go through tonight where weak business models turned into very weak business models. Eve, my take home that the market was too optimistic in January. Yeah, and that's maybe a really good thing, Eve. But also, Eve, I think some of it was, remember the RBA came out and kind of spooked investors by saying maybe there were multiple increases, so plural increases in interest rates to come. Whether or not we believe that to be true, I don't know. But number three is investors are more punishing than at any time in recent memory. So I did some digging and I saw an article on Market Index that crunched the data, I think it was over the last 5 years. And it showed that if a company didn't meet expectations of analysts, so when you go into Selfwealth and you see, say, for example, if we've got Domino's and we go into the forecast tab, and then you go down and you can see like the forecast here for revenue, EBITDA, profit, etc. When companies didn't meet these expectations by the 14 or 15 analysts that are surveyed, this reporting season, it was statistically true that they were sold off more than they were at any time in the past, on average in the past 5 years. And not only that, companies that exceeded analyst forecasts didn't go up as much. So compared to the average, the companies were hit harder, which is really, it's really interesting. 3% rate hike coming, says Chef Circle. Eve, you said, yes, they thought the interest rate cycle was nearly over. And I guess I kind of fall into that camp too, Eve, because the forward rates, so the forward rate curve, like the bond market was pricing in a bit of a kind of like tapering off. I did promise 3 key takeaways from reporting season, but there was a fourth, which is that companies just seem to be making stuff up. Honestly, they just seem to be making up like figures, like financial metrics that I've never even seen in my life. So they'll just take something and then they'll do something. They'll be like adjusted one-off normalized result underlying. And it will just be some craziness that's like not in an accounting standard. And they just think that they can get away with it. It's quite crazy. And that's where you get that, as you said, Chef Circle, the sentiment is changing. Next interest rate increase, John says, will be 0.15. And John, are you saying that because it takes it to a nice round figure? Is that why you're saying that? And then it kind of sets us back at a normalized 0.25. Jimmy, you've said, hey, I'm not fast. Market goes up long-term over time. Iron ore is firming, made a killing on Fortescue today. Did you now? What did Fortescue do today? Let me have a quick look at this. I didn't actually see. Oh, yeah, 3%. Interesting. Okay. Now, I'd love, maybe before we get to the next slide, if you can share with me some of the companies that maybe, let's have a bit of a confession ourselves. What were some of the companies that reported results that were really bad, or their shares were sold down that are in your portfolio? And conversely, which companies reported results that you thought were really good? Um, what do you think? What do you think? Like, which companies were those? I've got a few, obviously, that I'm going to share with you, but I'm curious what you see as some of the worst results this reporting season. And while you're doing that, I might just have a look around at certain things. If I can get some responses, I'm sure it's okay. We've all had bad companies, we've all had bad investments and seen them fall. I've had some of my investments fall 30% in a day. Jimmy, you've said Ample was impressive, bought heaps before the dividend. ALC, says Jennifer. What did Alcidion report? Actually, I think I have seen the Alcidion report. Down 7.4%. So, Jennifer, is this the first one that you've come across that's fallen this far, or is this just normal for you? And Mike, you've got A2 Milk. Yeah, we had a quick look at that last week. That was a pretty sketchy result, wasn't it? Let's have a look. So let's have a look at these results from Alcidion just really quickly. So Alcidion's going to be a lumpy business. So I just want to kind of like put that in there. So over time, I would expect it to be quite lumpy. Revenue up 48%. I mean, not too bad. 22% organically, not too bad. Gross profit up. Let's have a look. Yeah, okay. There's a meaningful increase in salary and wages. Operating expenses overall up quite high. EBITDA still, I would probably treat this, Jennifer, as probably like seems to be moving in the right direction, unless there was some sort of outlook statement. I'm normally across the business, but I don't seem to have it at the top of my head. So contracted revenue be able to be recognized was $32.9 million, an increase of 21%. Alcidion has a further $1.1 million of scheduled renewal revenue that is expected to be converted to contracted revenue. Although pressure on the UK health system, along with macroeconomic headwinds, have slowed some procurements in the UK. Okay, that's not the good news. Alcidion's strategic focus on initial module sales positions the company well to maintain sales momentum. Remains on track to be EBITDA and cash flow positive for 2023, subject to UK procurement timelines meeting expectations. Okay, so they've kind of tempered expectations there. I think I've told you in the past, one of the key things that I look for is the forward order book. So not necessarily contracted revenue, but if there's another Prezzo here, this one. Not this one either. Where's my investor presentation? Is this it here? No, that's a news bulletin. What's this one? Is that the same thing that I just clicked on? This one. No, okay, I'm going to go up here and go announcement like this. Is this the same one that I just clicked on? Yes, it is. Sorry, guys. I'll get there in 20 minutes or less. Okay, I can't seem to find it. I'm going to quickly dart across here. ALC. Go down and try and find the announcement that I'm looking for. Any other results that were really good or bad, guys? I mean, there are plenty more. Small cap WCG, Web Central, down 35%. John says, looked reasonable. Okay, interesting. I'll take a quick look at that. I haven't heard of it before. And I'm looking for, because I know many of you are interested in Alcidion, so I'm just going to look at the forward sales. So Alcidion typically report sales, and when they don't record sales, that's when you need to start maybe having a bit of a, I guess, you need to be more mindful. So some companies just drop the reporting of certain things. Not all files make it in, by the way. SPF report. Jason, right. Okay, not all the reports make it in. CSL, good results. It's interesting. CSL just keeps chalking up good results. They did talk about the reopening of blood plasma collections and that sort of thing. ACL is bouncing. I hope you mean the company and not necessarily your knee cap. Let's have a look. So I can't actually find where they've got their sales figures. Normally they report like total sales going forward. Maybe it was on the call. Sold revenue. Here we go. Sold revenue. So that will be fine. Yeah, so as long as that's positive, this is kind of a leading indicator for many investors. And if company have inserted the language about the UK procurement market slowing or being uncertain, you could probably expect this figure to fall in the year ahead. And that's probably the concerning thing. So that's probably the thing that I would say, Jennifer, is probably the thing to keep your eye on. If they are saying that, like, why are they saying that UK procurement is more challenging? I think that's the real concern. That's the leading indicator that I look for at Alcidion. But overall, I think the business is brilliant. Pilbara says Mike was good. It was excellent. Eve, when you said Elders, do you think Elders was a good result or not a good result? please let me know. So what was I looking for? WCG and WCG Web Central. Is this one of the? Okay, yeah, John. It's a very small company. Okay. Let's have a look. When I look at a tiny little company like this, I want to make sure. Go any news type. So has the company reported results recently, John? Let's have a look. Touch dribble. No. Has the company recorded results recently, John, or is this something new? Anyway, I'll come back to that in just a second. But UK government has broke the chef circle. Yeah, I mean that's probably the big thing. But yeah, see, the Alcidian is on for some of its modules. It actually has preferred. It's on a tender. It's got a approved tender status with the UK government, which means that it can actually sell without having to go through a lot of the hoops that a lot of the competitors have to go through. So that was probably about 2 years ago they achieved that, which is a massive massive improvement over some of the competition. So, Alex, hey Owen, are you planning to do anything in relation to Warren Buffett's 2022 letter in here on your podcast? I can, Alex, if I can, absolutely. I haven't actually read it yet. It came out, yesterday or the day before? I haven't actually read it yet, which is not like me. So, Eve, you just introduced Domino, so I'll continue with my slides. So, yeah, I guess, Alex, if you want me to, I will, definitely. I'm sure Drew's read it. And I was chatting to a guy called Nathan Bell today. The podcast came out today with Nathan, and we spoke about the letter. I haven't seen it. So I will have a look and I can cover that on the podcast. But in any case, if for those of you that don't know where to get Warren Buffett's letter, maybe just real quick to show you where you get them. So he writes an annual letter, obviously, and this is the place you go to get it, berkshirehathaway.com, and you can just click on the latest letter and read it at your leisure. But it's only a short one this year, so that's pretty good. Okay, so back to my slides. What did I think was pretty poor results? So companies that got whacked, Domino's was down 34% this month. Playside Studios, which is a business I've talked about a little bit here, mostly through Rask channels, down 40% in a month. A shocker, an absolute shocker. And not only was it a shocker, it was bizarre, was AMS, so the ticker symbol is AMS, but the company is Atomos. It suspended itself from trading on the ASX, so the shares are suspended, and it's conducting a review, and it hasn't reported its full results yet. But there's a twist to this result, and I just put it out on Twitter before. But the company, where are we? So the company came out with results. Here we go. So the company came out late with a result and said, we are doing a trading update and we've commenced a strategic review. So they've said revenue was $21 million, down 50%. Some of you may remember that this is the company that sells the kind of like the screens that go onto a camera. So you put the screen on the camera, and then what happens is basically it records from the camera straight into that device. So that's probably a big one. So unaudited underlying EBITDA loss of $11 million. So that's down circa $14 million. That's huge. Annualized fixed cost base reduced, non-cash impairment, early take-up of cloud services, requested a voluntary suspension from trading pending the finalization of an audit review process. So anytime that happens, anytime there's no audit and they need a review, that's interesting to say the least. But one of the things that I found was really curious is that, so Atomos has obviously had a tough time. Maybe I should do this first. I'll explain the backstory. So Atomos sells these devices that go onto a phone. So Atomos device, like this. So they look like these things, and they sit on the side of a camera, and the camera shoots the film straight into this device, which records, and then you can see it, and you can also stream it and send it and do a whole heap of stuff with it. So it's kind of like a camera accessories company. So interestingly, the company's share price has been absolutely walloped, at least since I started. I recommended the company back in the day, and it's been a pretty rough ride ever since. The founder resigned, then they brought in a new CEO who I thought was quite good, and who had a different, sales methodology. And she was basically booted out. And then she made claims against the company. And this furthered the culture. And the CTO was appointed as the CEO. And all the while, they still had an executive chair, so a chairperson who sat at the top and oversaw the company. But from my understanding, this is just my understanding, that chairperson was also running another business. So I didn't know how you could be actively involved in a ASX listed company while also running another business. Now, what's interesting is that now that all that's said and done, the share price has collapsed and the company has failed to lodge results. The chair has stepped down as a director of the company. But what's interesting here is that the company has now constituted to conduct a comprehensive business review and accelerate growth ambitions. The company will have access to Chris's historic perspective and corporate memory, as he is a principal of Henslow. So this is an investment banking company, which has been engaged to conduct a strategic review of the business. So if that sounds like gobbledygook, basically what happened is the chairman has stepped back, but then his company has been appointed to conduct the review of the company. So it's a bit of a weird thing, in my opinion. I've never quite seen that before, where the executive chairman steps down and then his company is appointed to do the review. I've never seen it. I'm not saying anything nefarious per se, but it's just a bit bizarre. So that was something that caught my attention as quite unusual. I got a few messages through Twitter as well, some companies that may have reported like quite poor results. So maybe I'll get to them. So Domino's was down 34%. I mean, hands up if you know, if you hold Domino's, I should say, not if you know it, but if you hold Domino's. So the company fell 34% this month. But the real thing is, why did it fall 34%? And the reason is that, and so red flag, yes, absolutely, Jaden. That's a huge red flag. And so a bit of history with the company. So Jaden, to your question, bit of history. Sometimes when I ask questions on analyst calls or investor calls, my questions get blocked. So if I ask a question, you know how they say you can dial in for the webinar at 9:30 a.m. today to ask the questions and whatever. And sometimes I'll dial in and I'll raise my hand in the Zoom meeting to ask a question, or I'll submit my question in the text box, but my questions get dodged. And I know that because they say there are no more questions. So they just simply don't answer them. So whenever I ask a question and a company fails to acknowledge that question, I always think to myself that I can't necessarily trust that. So and I kind of like, that's the red flag, Jaden. So I had that happen before with the company. So that was already a red flag. So unlisted. So not as bad as EML. Plant One, you've just brought up EML. Okay, I'll get to EML next. I totally forgot about EML. What a shocker that is. So Domino's Pizza, basically the reason why it got sold down, even though it reported pretty strong results. So I think I've got the results up here somewhere. I've got so many tabs open that I was just cramming to get all these results in and try and bring them up today, that I've just kind of like, I've just kind of got so many tabs here. So let me just bring this up a bit. Okay, so basically what happened is Domino's came out and said, released its results, and they weren't as good as what investors were expecting. Now, what's interesting is that then the company was pinged to basically suggest, and you can read that yourself down here. The ASX sent Domino's a message and said, you released this thing to the market disclosing that the profit from the ordinary activity, so the profit of the business, was down 28% compared to the prior period. So what is the information? Like, why did this happen? So does Domino's consider the information to be information that a reasonable person would have expected to have a material impact on the price or value of its securities? In other words, what this means is, did you know that the results were going to be bad before you submitted your results? Because if you did know, then you had an obligation to tell investors. Pardon me. And so they basically come out and said, no, we've looked at the analyst consensus forecast and we said it looked like, it was within our range, and we made a comment. So this is where, if you're an investor, this is where things get really tricky, because you have to pay attention very closely to the information and the language that is used. So here we can see Domino's considers that its mid to long-term earnings or profit is the material driver of the value of the shares, rather than the near-term earnings, such as the single half-year result, which it just released. However, even if the view is taken that the half-year results alone are material, Domino's considers that it is a reasonable basis to believe that the reported results are within the expectations. Because then they go on and say that they did make an announcement that said that earnings would be challenged by a difficult start to the year, and as Domino's offsets inflationary headwinds. So I'm going to unpack all that. I'm going to unpack all that nonsense for you. So basically, what they said was that the result at the AGM, the first half results could be quite weak, and people that missed that wouldn't have realized. And then the share price, so that might have been, sometime around here, and the investors are thinking, oh yeah, well maybe that's not as bad as they think. Maybe I believe in the company and blah, blah, blah. But then the share price continued to tank. And so the ultimate thing, what actually happened and why Domino's fell, is that the company is, as you know, Domino's in Australia is like a master franchisor. So they run the Domino's pizzas in Australia and Japan and some places in Europe. But the head dog is the US Domino's pizza. And that company came out and released its results and said, we're not pushing ahead with some of our growth plans and blah, 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 blah. And so that's the thing that kind of spooked investors. And then when these guys came out with their results and said, we're not probably, the growth wasn't as expected, everyone was kind of confirmed of that information, and it wasn't as good. So here we can see sales at the network level. So overall, the Domino's pizza businesses was down 4%. Online sales were down. The store count was up in the network. Profit was way down. And basically what's happened here is the business hasn't been able to offset inflationary pressures. So as the price of ham, the price of things have gone up, Domino's hasn't been able to offset that. And the problem is, the reason why it got sold down so much is that the shares were very expensive. So the shares, because it's a growth stock, traded at really high multiples. And that's ultimately what's happened. Now, there aren't many times, I would say this is a silver lining, there aren't many times when you can buy a really high quality proven growth business at a reasonable price. So this is definitely something that is going on my list. See, Chef Circle, you said, and a fitting name, Chef Circle, you said, customers are going elsewhere. Well, maybe, perhaps, perhaps. But I would just say I'm going to put Domino's on my watch list because it is one of those businesses in Australia that has proven itself time and again. So if Don May and the team at Domino's can revitalize the business, well, that's interesting. Paul, you asked a question before about which company was this. The company was Atomos that I was referring to before, not Domino's. They haven't dodged any of my questions. So that's one. Now let's jump to EML. Plant one, I totally forgot about EML. So EML is the global payments business. It basically allows startup companies. So let's say if you have a financial technology company, like a fintech company, and you want to take payments and you want to facilitate payments, well, you can go to EML and they'll help you to connect to Visa, for example. So you can take payments, and they help businesses like corporate businesses take payments or manage their employee expense programs, like it's a thing called in Australia, salary packaging. So they can do all that. But the company came out and basically said, like, the Irish regulator, which is the one that it's got in so much trouble with over the last few years, have said it's basically inadequate. So if you look here in this fourth paragraph, I think it is, or this third paragraph here, the Central Bank of Ireland, which regulates EML's some of its European business, considers that its subsidiary has made limited remediation progress to date, with significant and ongoing deficiencies remaining. CBA also notes that it is not satisfied with the remediation plan and timetable for completion. So basically, the company, the regulator, has come out and said, all the stuff that you're trying to fix up is not good enough. All that stuff that you're trying to fix up is not good enough. And so this is where, the business can, I guess, really like come unstuck, because they don't want this to turn into something bigger than it needs to be. The part of the business that the Central Bank of Ireland regulates for EML is actually not all of the European business, but at the same time, there's the thing that I guess there's the fact that if there is kind of where there's smoke, there may be fire. So other regulators may be looking and saying, well, hey, what else could go wrong here? What you're operating in our jurisdiction, so could you go wrong? Now, Plant One, you know this, but I'm going to refrain from making a call on EML because in the past I've kind of rode it on the way down and thought, well, it could get better. It looks cheap. It could get better. It's like that Simpsons episode where that Homer and Bart Simpson are chasing a roast pig that they've put together, and they were so happy with this roast pig. And it kind of just gets dragged through the mud. It bounces down a hill, and they say to themselves, "It's still good. It's still good." And that's what I often seem to think about EML. And every time I think that, something else bad happens. So I'm going to refrain from saying too much. But I guess when the kind of owner operator or long-term CEO Tom Cregan stepped back from EML, was probably maybe a year ago now, maybe not quite a year ago. That's when I started to get really worried. So I think the business could have a really bright future, and there's a new shareholder that's involved with the company, and I think was appointed to the board of directors, which is a positive for me. When an activist shareholder or even just an influential shareholder is able to appoint themselves to the board of directors and they have a pretty good track record, that's pretty good. That's a interesting sign for me. It's still good. It's still good. Yeah, you know the one, Jason. You know the one. Okay, so other unusual results. So Playside came out with its results. Not unusual, but so Playside is the company that I've mentioned before. It's an Australian technology company that makes games. I got to know where I put all these reports. Here we go. So Playside, it creates video games. So some of the video games you might see, if we have some examples, you might notice the Beans, Dumb Ways to Die used to be on the side of trains and trams in Melbourne. You can see the games that they're launching under that genre. And basically they create mobile or console games. And there are primarily three parts to the business, but only really two. There's the part of the game which they call part of the business which they call original IP, and this is where they create their own games. So they've got like Legally Blonde, Godfather, etc., etc. But then they do work for hire, or as they shorten it to WFH. Work for hire is where they work for other publishers. So like in this case, Meta/Facebook, or Activision Blizzard, or these big businesses, and they create the games for them. So they just use their development team and their designers to create games. Now, the big thing for Playside over the last few years has been the original IP, launching their own video games, which could mean that they earn all of the revenue from those video games. But rather, what's happened in recent times is that's been a bit weak. And so they've relied on the work for hire, which is basically just like saying, I'm like renting out my developers and renting out my games designers. The company is heavily insider owned by the co-founders. But if we look at the revenue build up here, we can see that the work for hire revenue was up substantially. It was up at $10.795 million, which was up 7.1 million. So it's a big increase in revenue. So you're thinking, okay, well, that's great. But the original IP, where they create their own video games, was down. Now, in the past, the business also had a thing, many of you will remember it if you follow small caps. The business in the past had this part of its business where it sold NFTs. So it sold non-fungible tokens, or they're like on the blockchain. And they made, I think from memory, I'm going off the top of my head, maybe between $8.5 and $10.5 million from selling those NFTs. And this is revenue that they got once off. So that was a big hit. It was basically like 100% profit margin. And so that kind of can't be repeated. So here we can see revenue is up, but you can see the costs were way up. And that's why it ended up with a net loss of $5.5 million. And they go on to expand on that in the half-year report, where they say the main increase in expenses, where is it? The main increase in expenses was employee expenses, because I remember sitting on a call with the CEO and co-founder, Jerry Sakis. And I think I asked a question around do you have you hired too many people, and how are you thinking about balancing the workload of the team? And I think they quickly grew the business in anticipation of further growth. And now what we're seeing is the company report a steep loss, and shareholders and investors are just punishing the business. So if we go back to this takeaway here, punishing any business that is kind of weak, because if interest rates and inflation are on the way up, right? If interest rate and inflation are on the way up, what happens is capital, like shareholder capital and money in your brokerage account becomes more valuable, because why would you invest it in stocks that seem to be really volatile when you could go put it in your bank account and earn savings and interest on that? So that's it. Second office would do that. Yeah, that's right, Jason. So Playside rolled out a second office on the Gold Coast. So that's probably increased the costs. Rio Tinto cut its dividend in half. BHP cut its dividend by 40%, which wasn't great. Wesfarmers, I would say, was a good result, except that they spent, I think they incurred about $100 million loss on Catch of the Day, which they're rolling out now. My co-host on the Australian Investors podcast, Drew Meredith, kind of pointed out that even though the company reports really strong results, perhaps it's because, inflation, but through Bunnings Warehouse and through Kmart, they're able to push some of those costs back onto consumers. So here we go. Also worth mentioning is like that coming out of COVID times, the business is kind of growing out of that, which is pretty positive. I still think Wesfarmers is one of the best businesses in the country. So if I get the opportunity to buy shares, I definitely will. And I would just need more weakness in the share price for that to happen, to be honest. This would be, put it this way, Wesfarmers is probably one of my top 5 businesses to buy. I don't own it now on the ASX if things really hit the fan. I think it's one of the most impressive businesses on the ASX for many reasons, including it being diversified. It owns Bunnings. But if you think about it, if property expenditure and prices and access to credit is going to be more difficult in 2023, as well as people spending less on retail, you can expect that all of these businesses, except for maybe the fertilizers business, would struggle. In that case, I would be expecting there to be weakness in the share price, and that's when I'd be looking to buy it. I would add one extra thing and say that the company has heaps of cash on its balance sheet from memory. I don't know the exact amount, but it's got heaps of cash available and heaps of ability to make acquisitions. So if that's the case, I wouldn't put it past them to really go on the offensive if things do get bad. So if things get really bad, I would expect them to be active and buying other companies. So that's what I think. Was Wes forced to demerge Coles? Will this happen again with other big franchises? Stevie, that's a good question. What do you think? Like, what I guess, what other big franchises are you thinking about? Because I don't know which ones you might be referring to. Because I don't think it was forced to do it. I just think that it was the right decision, because you got to remember, Stevie, when they bought Coles, I think it was from memory 2007, and Coles at the time had terrible profit margins. I think Coles had profit margins in the realm of 2.4%, EBIT operating profit margins, and then by the end of it, they're up around 4% or 4.5%. And so while that might not seem like a big difference over, say, 10 or 15 years, if you multiply the profit margin by the amount of revenue and sales that Coles and all that was making, that's a huge difference. That's why it was so good. In terms of price earnings ratio, like what would I be willing to pay for a business like Wesfarmers? I think I'd have to do a full discounted cash flow analysis on a business like Wesfarmers. But what I would be looking at is I would probably be looking to pay any multiple which is kind of in line with the market. So let's say, for example, and I just take a small position at first. So say, for example, the price earnings ratio is, I don't know, of the market, let's say it's 15 times. I think Market Index has this as statistics. Oh, that's not how we spell statistics. So one of the things, and that's not how we spell it either, Owen. There we go. Statistics. God, I'll get there. So if we go here, we can see that the long-term average, where is it, price earnings ratio of the ASX is around about 16 times, right? And so we can see in January 2023, it's around 16 times. Now, if I could buy a business like Wesfarmers for that amount, then I would probably say that that's a good buy. Now, you might be saying, well, that sounds a bit weird, Owen. What are you talking about? So say, for example, if you get the normalized price earnings ratio, here it's 21 times. The way I think about it is that, and there's a really good investor here in Australia that does this, and it's really simple. as a valuation heuristic. Like I said to you before, I would do a DCF. I would do a full discounted cash flow analysis. And there's actually value of everything. Course. There's actually a free course that we have on YouTube, this one right here, which takes you through how to do a valuation of supermarkets. So I did it about 7 or 8 years ago, but it's super popular, and it actually it uses Woolies as the case study, and you can just take that model of valuation and you can apply it to Wesfarmers, like drop of the hat. It's that easy. So if you are really interested in getting into the weeds, you can go and do that. If you take the course that's on our website, it's $99, and you don't need to. It's the same videos. So, so what I would say is getting back to how you can kind of value it with a heuristic. So if you don't know what a discounted cash flow analysis is, that's fine. The way this investor, his name is John Garrett. He's a brilliant investor, and the way he invests, and he's not the only one that does it this way, but he's a super smart and really good investor. And he basically says that if a company's, PE ratio, the price to earnings ratio, is above the market average, is that reasonable if it is an above market or above average business? And you might think, well, that's so simple. Like if the average is 16 and Wesfarmers is 22 here, does it deserve to trade at that level? The answer is yes. Now, if Wesfarmers fell to 16 times, would you say that Wesfarmers is an average business on the ASX? I would say no. I'd say it's one of the highest quality businesses on the ASX. So I would be looking at, well, what is the market average pricing of a company, just any old company? So this is all of the companies on the ASX, every company in the All Ords. And then I'd say to myself, well, what can I buy it for? Now, there's another extra layer that you could take here. You could use a few different metrics, but you could exclude things like cash, and you could do like an enterprise value where you're not comparing price to earnings. You're comparing like enterprise value. It's a different thing. You can look it up. Jason, so you said, yep. So simple, right? Take the price, divide it by 21 times 15. That's the attractive price. What I would say, Tom, so what I would say is simply just compare the PE ratio, Jason. So a lot of investors do this. So if the average is 15, and you think the company is above average, you would expect it to trade for a PE ratio higher than 15, right? So that's kind of the heuristic. It's not perfect, but it just gives you a sense of the relative value of something. A lot of investors that I speak to, they do something a bit more complicated where they do something called comps. So a comp is like where you get like the price earnings ratio of Wesfarmers, the price earnings ratio of Coles, the price earnings ratio of maybe like the Home Depot in the US, and you get all these price earnings ratios and you compare them. That's where the comp comes from, the comparables. And then you say, well, based on the average, it should be higher, right? Yeah, sure. That's one way to do it. But an easier way is just to look at the market average and say, well, what am I prepared to pay? Yeah, that would be the thing. And so, Jason, you, Chef Circle, you just brought in something which I might just add to this. So you might be saying, oh, and that's really basic. So if you look at Macquarie Group's price earnings ratio. So here we go, 15, right? If you notice, there's a normalized one here too, Chef Circle, that's 26. You got to be mindful. What I was just saying, that heuristic of like just compare it to the market, that only works if it's the actual earnings. Like if you're actually looking at the company's true earnings, like the true profit. Because if you're just taking like the price earnings ratio and you're using the earnings, the E is like a cyclic, like it's not an accounting, like it's not the standard earnings, like it's not sustainable earnings. It's like a really high or low value. Your multiple is going to be flown off. So what you've got to do is you've got to identify the stable earnings of the business when you do this comparison. So here we go. We'll just look at these two things, right? So it doesn't actually show much difference here with this metric, but here we can see, that's going forwards in time. So here we can see earnings per share, right? We want to make sure that we're using, in this case, it's pre-exceptional items. We want to look at something like that. But another way you can do this, and Chef Circle, you will know this. Another way you can do this is you can just use, it doesn't have to be a PE ratio. You can use the dividend yield as well, right? So the average dividend yield of the All Ords, according to Market Index, in January was 4.3%. So you can use the valuation heuristic there, and you can say, well, if the dividend yield is above that, is it cheap? if the dividend yield is lower than that, is that expensive? And that's honestly like how some people value bank stocks. They say, well, I can buy the Vanguard VAS, ETF and get a dividend yield of 4.3%, or I can buy Combank and get a dividend yield of, let's have a quick look. I can get a dividend yield of, I can get a dividend yield of 4.2%. So what this is basically saying is investors think the Commonwealth Bank is slightly better than the market because it's got a slightly lower slightly lower dividend yield. And so the higher the dividend yield, you've got to imagine that investors are valuing it less, if that makes sense. So that's kind of how this heuristic works, but only do it with companies when you know the true earnings. Don't just go and apply it to any old company. Anyway, I've kind of gone way off track as I usually do. So Harvey Norman down 15% in a month. And then I think I saw a few news articles where Jerry Harvey came out and just, flung some stuff in every direction. I don't know why. He was a bit perplexed as to why the share price went down. And one of the big reasons that I can think of that maybe the reason why the company's share price went down is there's something really strange happened. The company's property was revalued down, but it was still up. So if you think about this, when interest rates go up, what happens to property prices? They fall. And in this instance, it seems like the property is still worth more. So investors were asking the question, well, is that a true reflection of the true value of these properties? And I think that was one of the concerns amongst analysts. Another concern was that sales obviously fell, but profit fell in a much bigger way. So profit fell quite substantially from 433 million to 370 million. And to be honest, the fact that it's still profitable to the extent that it is, that's still really impressive. So I mean, credit to Jerry Harvey and Harvey Norman for doing that. There are always some questions about the accounting standards that they interpret, but for the most part, not a bad result. Just the share prices got whacked. So there were some more kind of concerning results. One of them was from Pointera, which is a small cap company that does like big data and technology. Probably one of the most obvious concerning results for me was Zip Group, which is the buy now, pay later company. You've probably heard the news that a lot of other buy now, pay later companies have gone out of business. The company reported revenue of $350 million, but a loss of $242 million. So it's reporting a loss that's looks like it's not even that far away from the total amount of revenue, which is a big thing. So if we go down to the financials, and Drew and I spoke about this the other day, actually. If we go down to the financials, we can see here that the business's revenue is here, but we see, bad debts expense wasn't that high compared to the previous period, which is a little funny. I thought that bad debts expense would have gone up. But you can see a bunch of these other costs have just kind of crept higher. And that's what's ultimately led to a loss of 235 million. Now, one of the things that you can't really do with Zip, normally what I do when a company's losing so much money so quickly, like its business is not profitable, what I normally do straight away is I normally go to the balance sheet and go, okay, well, if that's how bad this thing is, how much cash do you have in reserve? It's kind of like if you lose your job, how much cash do you have in the bank to pay the bills? That's basically what I'm asking here. So you're losing money in your business. So how much cash do you have to support that? They've got $153 million here, right? But if we go down and we go to the cash flow statement, which shows us the true outgoing cash flows, the thing that's concerning is like, even as me as an analyst, I don't know how to interpret this cash flow statement because Zip is basically half bank, half normal company, because it's like a technology company, but it also does lending and it's losing money on its lending. So it's really hard to price that because you're like, well, which cash flows are going in which direction? So for example, you've got revenue from customers right at the top here. Then you've got all the payments and blah, 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 blah. But normally this would say cash receipts. And then you'd come down here. And normally what I'd do as a rule of thumb is take this number and this number and add them together and say, okay, that's my rough figure of where cash is going. So here we can see 226 million out, 220 million out, right? So that's $248 million going out the door just in the half year, I believe this is. So they've only got 260 million left, 270 million. So they've basically got 6 months worth of cash if you just took that. But then if you look further down, they're borrowing money to fund the business. So they're borrowing money, they're repaying some of it, but they're borrowing money. And so overall, banks don't lose money, it's just a circle. Here, you can see me like scratching my head. There's Siri. So Stevie, you asked a question. Looking purely at individual business and brand, do you prefer Officeworks or JB Hi-Fi? Oh, JB Hi-Fi, Stevie, for sure. Harvey's worse than Elon, says Jason. He's best kept silent. So in other words, I actually don't know what's going on inside Zip, and I don't own the shares. And what's that old saying? Like, I don't want to talk bad about companies tonight, even though they reported some pretty shocking results. Like, that happens. I would just say I wouldn't want to be owning Zip, even now with it so low. I still wouldn't. Unless the economy or they figured out how to do buy now, pay later profitably, and there are good bits of Zip, don't get me wrong, but I just couldn't do it. I just wouldn't have any, insight into pricing the risk of the business. It might be great for consumers to, borrow that money. Maybe it's harmful, but for me, no, thank you. Okay, so there's one more kind of company. One more company that Max brought to my attention on Twitter. I won't go into too much detail about it, but this company is Dubba, which does voice recording technology. So you can use the software to record your voice and take notes, or you can do it for compliance. Like if you're in the bank and you know how you call the bank and they say, this call is monitored for quality and compliance purposes. Well, they might be using Dubba software. And so revenue during the period was 14 million, which was down 13%, and the net loss was 37 million. So they lost more than twice the amount of money that they earned in revenue. So that means they're spending a lot in short. So if we go down, they're going to do a restructure, which is probably positive. I think they've got a new director as well, like a chairman, I believe. So the business reported that 14 million revenue, but you can see where all the costs are going out. And you can see it reported a loss of 37 million. If we go down to the cash flow statement, remember this is that question of, okay, you're reporting a loss. Well, what cash do you have in the bank? It's got $27 million of cash in the bank, $27 million of cash. It doesn't have any debt, although it does have some leases, like for office buildings. So it's got, what did I say? $27 million of cash. This was 2 months ago. So this was December 31. And then if we go down and we see how much cash is actually going out the door, $27 million went out the door during the period. Now I look for how much of it is likely to continue into the future. It all looks likely to continue in the future unless they cut costs. So normally you can have a company report a cash outflow, like it can be losing a lot of money because it makes one big, like it purchases another business or it acquires a property or something like that. In this case, there was none of that during this period in here. There was none of that. So it was really just, this purchase of property, plant, and equipment, which is only $700,000 for a business of Dubba's size, is probably likely it could continue. You can see there was something else in that period last year. So in short, $27 million going out the door in the half year, $27 million in the bank account. So yeah, I mean, there are a few options. They could maybe take on some debt. They could maybe sell some shares, like do a capital raising. They'll probably have to do either one of those things and restructure the business, which is what they're doing. So the CEO said, the review and restructure announced today highlight our primary focus and commitment to the customers, building a world-class platform. We've not gone into this lightly. I understand and appreciate the sensitivity for our colleagues who are impacted by the restructure. So it sounds like there might be some job losses or something like that. So, Jason, you've said Dubba, wow, $37 million for a recordings company. How does that cost so much? What's Dubba's headcount? Well, it must be pretty high. But Dubba also has some really unusual. They also have some really unusual. I don't know. how do we call it? Incentive schemes. Really unusual incentive schemes. Stevie, you said, oh, when ABC just released a story, government is going to crack down and regulate buy now, pay later firms. Bad news for these companies. For sure. That's bad news. Martin, you've said, Dubber, how do they pay themselves, cash or stock? Well, I think Mike says Dubber is a strong sell. So if I go to my notes here, so yeah, I mean, I don't really want to go into too much. I've said a lot about this company in previous times, Martin, and I've kind of called it out a bit. And it's probably like I probably said enough now. The writing's probably on the wall a bit for it. But what I would say is that some of the incentive schemes that the company has adopted in times gone by were kind of a bit aggressive for me. If we go up here, so they have like the salaries that they pay, but then they have share-based payments as well. And you can see last year there was $11.5 million of share-based payments last year. Like that was in 1/2 of a year. But then they've also got admin costs. So that's here too. And if we go down to note 8, I don't know what this is. Note 8, so share-based payments. Yeah, I mean, there's a few things going on here. We probably don't have time to get through them, but you could go through and look at that sort of stuff, Martin, and you could just say that I didn't think the incentive schemes were tied to shareholder value creation for all shareholders, is what I'd say. Okay, let's end with some more positive stuff. So I think Wesfarmers' result was a pretty good result. I think CBA's result was brilliant, but the key thing is not this result. It's what's the next result, and the next result is when CBA has to deal with potentially rising impairments, and that's the key concern. I think Altium's result, which we spoke about, was pretty strong, even though it was sold off. I think it's okay. I think the business might slow down, but I think the tailwind of more people, more engineers using software to connect the software designs that they create for their electronics into a factory, which is where Altium's trying to position itself in the middle. I think that's going to continue. Hub24 reported its results. You might remember from a week ago or the week before. Really strong results. Net Wealth's result it was good, but it didn't have the outlook. So it had a pretty weak outlook. Even though I said yes here, it had a pretty uncertain outlook. But I don't think many companies do have a certain outlook at the moment. Pro Medicus's results was easily the best that I come across. And I own shares in Pro Medicus, so full disclosure there, I'm so biased. But it was, yeah, I think Mikey said that earlier on. Yeah. Charles, you've said ARU. I don't actually know the company, I believe. So Arafura Rare Earths. I do not actually know the company. What I would say, I don't know this business, but just based on the name Rare Earths, this is what I'd say, is make sure in this market environment that the business that you know the downside, that you know the risks, because with interest rates up, it's harder for speculative companies that aren't profitable to raise capital and to actually build a legitimate business. That's what I would say. I don't know anything about this business, but rare earths tends to be a capital intensive business. So just make sure that's the case, and that it's all, it's not a question of if it will survive. I was going to do an Ask Me Anything where you could just ask me anything, but maybe we'll save that for next week. Or maybe I'll answer the first question that comes through. If you have any questions on your mind, please send them through now, and I'll answer one question before we run out of time. There's this quote, and Warren Buffett, I heard it repeated again. I don't think it was from the letter, but this is very prescient, I guess. This is telling of the world that we're going into in 2023. So when Warren Buffett is asked about whether he would use debt or leverage to make an investment, he's come back with a few quips over the years. And one of them was this: if you're smart, you don't need leverage or debt. And if you're not smart, you shouldn't be using it. And I think what's going to happen this year is many of the companies that we thought were really good companies that loaded up their balance sheet with debt are going to find that that was a bad idea. And many of the people who use a lot of debt in their lives with personal loans for cars, especially cars, housing, investment properties, I think 2023 is a year, in my opinion, more than ever, when it is vital that your balance sheet, personal balance sheet, and the company that you're investing in balance sheet is rock solid. And in my mind, there's no reason that I would even consider using any form of debt going through 2023, based on what I've kind of pieced together from economic updates, company reports, and what I'm seeing in the personal finance land. I think now more than ever, it pays to just de-risk your personal balance sheet. And even if that means lower returns, it's a sleep at night factor for me. So yeah. Okay, some quick questions here. We've got, what's your star sign? I'm a Libra, Rob. Good question. Zim, don't know the business, Jennifer, but I can put that on the list for next week. Nick Scarley, Chef Circle, brilliant company. Tats numbers, don't know what they are. Paul, brilliant businesses, Nick Scarley. Don't know if I'd buy it right now just because of the uncertainty in the market. The gold sector, says Tom. What's your view on the gold sector? Well, to be honest, Tom, this is the thing, right? I can turn off my screen now. This is the thing about gold. Definitely not personalized advice here. I'm just answering investing questions. Absolutely, Rob. So the gold price was meant to help people when inflation comes back, and inflation came back. And I don't think it really worked as well as people would have liked. So for me, as a whole, I have a little bit of a gold allocation in our core portfolios, but I don't really it's a very small position. It's like 5% or something like that. But if I was going to invest in the sector, Tom, you've actually said something as a follow-up, which is NST, which is Northern Star Resources. The ticker symbol is NST. It's this company right here. I've always been impressed. Of all the companies on the entire ASX, this is the company that has always impressed me from a gold mining perspective. Now, I don't know if that will continue, but it's just always impressed me as a business. I don't invest in it. I don't really research gold that much, but I remember when this was a tiny small cap stock, and it's grown to be one of the biggest and baddest, in a good way, gold miners on the ASX. So that's what I would say. Thanks for your research, says Ra. Thank you. Even homeowners are finding out the dangers of leverage/debt, Stevie. Yes, they are. Years of bullish property market taught them to borrow more and more. Yeah, but it only goes up, Stevie, doesn't it? I'm joking, of course. It doesn't always go up. When Saturn opposes Neptune, the market's always crap. Mike, you said it best. The star signs are what count. Absolutely. Obviously, tongue in cheek. Very proven, as Rob said. Okay, so I don't have a chance to answer all the questions, but Stevie, one final one. You said, I feel gold is like the 10% bonds allocation in VDHG. It was meant to hedge, but didn't really do anything during 2020 to 2022. And that's true. That's what I found, Stevie, is that gold didn't really do what it was supposed to do. All of the theory suggested that gold would be a hedge against uncertainty and a hedge against inflation. And it really wasn't what people had expected. And so, I've said his name too much, but Warren Buffett always had this view that you don't necessarily need gold in a portfolio. You don't necessarily need it. Now, I've met some really smart people that say that gold is the best investment and that, it's got intrinsic value because it's shiny when it sits on your finger. But does that make it a good investment? For me, it doesn't. What makes a good investment, in my opinion, is something that increases in value regardless of the economic environment and pays an income stream. And so gold tends to be dependent on the economic environment and it doesn't pay an income stream. So it doesn't really meet either of those two criteria for me. So that's why we've only got it as a very, very small part of our model portfolios, but it's still in there because of that statistical, backing. So can't eat gold, says Jennifer. I wouldn't know. I haven't tried, but if you have tried, it's probably not good. Although I do know that in the past they used gold for certain medical procedures where they would use it in joints and limbs to ease arthritis or arthritic pain. I don't know how that ended up. Anyway, so thank you everyone for joining us tonight. Rob and I are actually working on something behind the scenes where so divisive, says if it is. So we're working on something behind the scenes. Hopefully we can do some more mini series for you. So if you did like the passive income mini series with Drew Meredith and Jamie Nemsis, which I think you did, around 10,000 people tuned in for those episodes, we're going to do more of them. So if there's anything that you want us to cover, please reach out to us. You can reach out to me. I'm at Owen Rask on Twitter, but just reach out. because Rob and I are keen for ideas. You can send Rob an email, marketing@selfwealth.com.au. And I think you'll like, if we can get these guests for this next series that we're hoping to do, it's going to be fantastic. Absolutely fantastic, you could say. So fingers crossed that goes ahead of the next month. But I was also thinking we could restart you remember our old portfolios, the low tofu and high stakes portfolios? I think that could be a bit of fun too. So yeah, that's marketing@selfwealth.com.au. So thank you everyone for making time tonight. Thank you everyone for that watches on replay, particularly those of you in Perth. We know the time zone isn't doing you any favors. So hopefully when daylight savings readjusts, we're in business. But thank you. We all want passive income, says Sparky. So we don't have to be a slave to someone else. Absolutely. That's what we're all working towards. So bye for now. Thank you on behalf of Rob and I, and we'll see